From 2014 to 2016, the world experienced a significant oil crisis marked by a dramatic drop in oil prices. This period was characterized by substantial shifts in the global energy market and had far-reaching economic impacts. The drop in oil prices. The oil crisis began in mid-2014 when oil prices started to plummet. Prior to this, oil prices had been relatively high, driven by strong global demand and geopolitical tensions in key oil-producing regions. However, several factors converged to cause a sharp decline in prices. Increased production. The United States played a crucial role in this decline due to its surge in oil production, particularly from shale oil. Advances in fracking technology allowed the U.S. to produce oil at a much higher rate, contributing to an oversupply in the global market. OPEC's decision. The Organization of the Petroleum Exporting Countries, OPEC, which includes major oil-producing nations such as Saudi Arabia, decided not to cut production to stabilize prices. Instead, OPEC chose to maintain its production levels, which exacerbated the oversupply issue and led to a further drop in prices. Global demand. While oil production increased, global demand was not growing at the same pace. Slowing economic growth in key regions, particularly in China, contributed to reduced demand for oil, further driving down prices. Economic impacts. The collapse in oil prices had wide-ranging effects on the global economy. Impact on oil producers. Countries that heavily depend on oil revenues, such as Russia, Venezuela, and several Middle Eastern nations, face significant economic challenges. Lower oil prices led to reduced government revenues, budget deficits, and economic instability in these countries. Effects on oil companies. Major oil companies saw their revenues decline as oil prices fell. This led to reduced capital investment, job cuts, and restructuring within the industry. Some companies even faced financial difficulties due to their heavy reliance on high oil prices. Economic stimulus. Conversely, the drop in oil prices benefited oil-importing countries by lowering energy costs. Lower gasoline prices translated into increased consumer spending and economic relief for nations that rely on imported oil. Market adjustments. The oil industry underwent significant adjustments during this period. Oil companies focused on cost-cutting measures, technological innovations, and strategic shifts to adapt to the new price environment. Some companies also scaled back their operations or shifted their focus to alternative energy sources. Conclusion. The oil crisis from 2014 to 2016 was a period of significant volatility in the energy markets. The sharp decline in oil prices reshaped global economic dynamics, affecting both oil producers and consumers. The adjustments made during this period continue to influence the energy sector and the broader global economy.